Hey everyone, let's dive right into the fascinating world of futures trading and decode the basics in just a few minutes. Whether you're a beginner looking to expand your trading horizons or just curious about how futures work, I've got you covered. First things first, what exactly are futures? In simple terms, futures are contractual agreements to buy or sell a particular commodity or financial instrument at a predetermined price at a specified time in the future. Pretty straightforward, right? Now, why would you want to trade futures? Well, they are a fantastic way to hedge against price fluctuations, especially if you're involved in industries like agriculture or energy, where prices can be volatile. Not only that, but they also offer incredible opportunities for speculative trading. Let's talk about how you can get started. The first step is to open a brokerage account that allows futures trading. Make sure to do your research and choose a broker that aligns with your financial goals and trading style. Once your account is set up, it's time to dive into market analysis. This is crucial. You need to stay updated with market trends, economic indicators, and other factors that could influence the prices of the futures you're interested in. Remember, knowledge is power in trading. Now, selecting your futures contract. Each contract has specifics like the contract size, expiration date, and the commodity or asset involved. Start with contracts that are commonly traded as they offer more liquidity and typically less spread between the buying and selling price. Before placing your trades, it's essential to understand the terms long and short. Going long means you expect the price of the commodity to go up, and you'll profit from buying low and selling high. Going short is the opposite. You anticipate a price drop and aim to profit from selling high and buying back lower. Risk management cannot be overstated. Futures can be highly leveraged, which means you can control large contracts with a relatively small amount of capital. While this can result in significant profits, it also increases the risk. Always use risk management tools like stop-loss orders to protect yourself from market volatility. Finally, practice makes perfect. Consider starting with a simulation trading account to hone your skills without financial risk. Once you feel confident, start small, keep learning, and gradually increase your exposure as you gain more experience. Remember, the key to successful futures trading lies in continuous learning and strategic planning. So keep your eyes on the market trends, stay informed, and always manage your risks wisely. Happy trading, and I'll see you in the next video.